Now, greetings and welcome to the lesson. Today we turn to the auditor's report. This is a topic that has 14 subtopics. Number 1 is the purpose of auditor's report. Number 2, statutory provisions on audit reports. 3, basic elements, contents of audit reports. 4, emphasis of matter paragraph and key audit matters. Number 5, types and consequences of different types of audit reports. Number 6, there are features of unqualified and qualified audit reports. Number 7, reasons for qualifications of audit report. 8, types of qualifications. 9, overall audit review and finalization. Number 10, subsequent events. 11, going concern review. 12, management representations. 13, review of compliance with accounting policies. And lastly, format for presentation of auditor's report. Auditor's report. Now, candidates, an auditor's report is a formal document that is issued by an independent auditor after conducting an audit of a company's financial statements. So it is a formal document, because you all know that at the end of the audit process, the auditor is required to express an opinion on the reliability and the credibility of the financial statements, and the auditor is also required to express an opinion as to whether the company has complied with the applicable financial reporting framework. That is a requirement, and the auditor expresses such an opinion in a formal document we are calling an auditor's report. It is a formal document issued by an independent auditor after conducting an audit of a company's financial statements. And its primary purpose is to provide assurance to users of the financial statements that they are free from material misstatements and that they give a true and fair view of the company's financial position, financial performance, and the cash flows. So what is that's a general purpose. We have to outline the other purposes. Purpose of auditor's report. Now, the first purpose of the auditor's report is to enhance credibility. The auditor's report enhances credibility. It provides assurance to stakeholders that the financial statements are reliable and trustworthy. So the report increases confidence in the accuracy and fairness of the financial information. Number 2, it also promotes accountability. The auditor's report promotes accountability. It holds management accountable for the accuracy and integrity of the financial reporting process by encouraging adherence to relevant accounting standards and regulations. It is the responsibility of the management to ensure that the financial statements are prepared in line with the acceptable financial reporting framework, the generally accepted accounting principles, the international financial reporting standards, the international accounting standards, and so on. That's the role of the management, to ensure that the financial statements are prepared in accordance with the applicable financial reporting framework. So the auditor's report holds management accountable for the accuracy and integrity of the financial reporting process. It encourages adherence to relevant accounting standards and regulations. Because the auditor's role or responsibility is to give an opinion as to whether the management has complied with the accounting standards and regulations. So the auditor gives his view as to whether the management has done so, and by so doing, that promotes accountability. Another purpose is to protect investors and stakeholders. All right. The auditor's report helps investors and other stakeholders to make informed decisions based on reliable financial information. The report mitigates the risk of fraud and the risk of misrepresentation. So, facilitates decision making. The audit report facilitates decision making. It provides a basis for sound financial decisions by various stakeholders, including the investors, creditors, lenders, and regulators, and so on. Now, another point, let's make them 5. It may offer recommendations for improvement. An audit report may offer recommendations for improvement. It may provide insights and suggestions for improving financial processes, control systems, and so on. It may also help the organization to strengthen its internal controls and operational efficiency. Recommendations for improvement. Now let's move on to the concept of true and fair view. Let's study the concept of true and fair view. The concept of true and fair view. Now, the concept of true and fair view is a fundamental principle in financial reporting. All right? True and fair view is a fundamental concept in financial reporting, and it means that the financial statements should accurately reflect the economic reality of the company without material misstatements or bias. True and fair view. For example, if the financial records indicate that the company's total assets amount to 100 million on paper, that should be so in reality. If you are to check the physical assets, if you are to evaluate, to do evaluation of the physical assets, then the value should be the same as what is on paper. If the bank balance as at 31st December is, say, 10 million in the books, that should be the case at the bank. That's the meaning of true and fair. The financial statements should accurately reflect the economic reality of the company. Economic reality, the things on the ground. Because you see, financial statements are just assertions. The information in the financial statements are assertions. What the management is reports gives as a report in the financial statements. What is reported in the financial statements ought to be true and fair. That is to mean that the assertions should accurately reflect the economic reality of the company without material misstatements or bias. And the auditor's role is to assess whether the financial statements give a true and fair view by considering things like fair presentation, fair presentation. Now we are looking at this concept from the perspective of the auditor. The auditor's role is to assess whether financial statements give a true and fair view by considering several factors. The auditor looks at the presentation. The financial statement should be presented in a clear, concise, and understandable manner. And furthermore, in checking for the truthfulness and fairness of the financial statements, the auditor should also consider materiality. Materiality, this is a very important factor. Materiality. The auditor should identify and assess the significance of any misstatements, considering their potential impact on decision making. If there is any misstatement, if an item is misstated, then the auditor has to check the materiality of such a misstatement. 3, going concern. That's another factor that the auditor should consider. The auditor should assess whether the company is likely to continue operating in the foreseeable future. Consistency. When checking for the truth and fairness of the financial statements, consistency is a factor to consider. The financial statements should be prepared consistently from one period to another, from one period to the next, unless there are justifiable reasons for changes. Consistency. If it is accounting policies, they should be applied consistently from year one to the next to the other year. Consistency. 5, compliance with standards. That's another key factor. Compliance with accounting standards. The financial statements should comply with the relevant accounting standards and regulations. We are talking about compliance with standards. The financial statements should comply with the relevant accounting standards and regulations. True and fair view means that the financial statements should accurately reflect the economic reality of the company without misstatements and without any bias. And the role of the auditor is to assess whether the financial statements give a true view of, or a true and fair view by considering various factors: the fair representation, materiality, going concern, consistency, and compliance. So the auditor is required to provide reasonable assurance that the financial statements give a true and fair view. That's the role of the auditor. The auditor plays a crucial role in maintaining the integrity of financial reporting and protecting the interests of the shareholder. So, Candace, that's the meaning of true and fair view. True and fair view.